June 14th, 2024. Today, pretty interesting. We got a reversal up from exactly yesterday's low, and we had an IOI pattern on bar 42. And on Monday, we had, again, a reversal up from the prior day's exact low. And it was in here, it was an IOI pattern as well on bar 42. This was actually an IOII. But the point being, whenever the market does something early in the week, like a reversal up from the exact low or some sort of pattern, I pay a lot of attention in general to what the market does on Monday and Tuesday because it might try and emulate it on Thursday and Friday, and especially Friday. You can see we got a reversal up from yesterday's low on Monday and a sell climax on the open and then a low of the day on Tuesday. And today, we got a reversal up from yesterday's low as well as a couple of sell climaxes on the open. So again, I usually, whenever, Monday and Tuesday happen, I try to take mental note of what happens on Monday and Tuesday since the market often tries to do those same things later in the week. We had a gap down, and bar one is a bull bar closing near its high. It's good for the bulls after the gap down. They're hoping that the gap down was just a bear trap and that we're going to get a higher low double bottom from bar 36 yesterday. This is bar 36. It might be 37. Hold on. $37, yeah. So from bar 37 yesterday, it's reasonable to think, whoa, what's going on here? Okay, whatever. It's reasonable to think that we're going to get a double bottom with bar 37 yesterday because it was such a big bar and such an important support point. So it was important to note that we might end up testing all the way down to here. Follow through for the bulls on bar two. It's consecutive bull bars closing near their highs. Good for the bulls. We're probably always in long. I think, it might be by the close, but it's also, the open. So on the open, 80% chance of some sort of trading range happening. So it's not all that likely that we're just going to rally straight up for, 10 plus bars, 80% chance of some sort of minor reversal on the open lasting at least 5 bars, which tells me that this might not go all that much further. And as you can see, we get a disappointing follow through bar on bar three. Bar three, probably buyers not too far below, probably sellers not too far above. Traders who are bears, they see the big gap down and they see bar three as essentially a low one short, but it's probably not a good low one short because bars one and two are really strong. So consecutive bull bars, we're probably still always in long. Therefore, three is not as good of a sell as it could be. And for the bulls, they see a high one. They're hoping three is just a pullback from the strength of bars one and two. One and two is good enough for a second leg. So the bulls who were buying the close of two knew that we might pull back and we might not get another strong follow through bar on three. But they were betting that if we do pull back, they'll be able to buy the pullback, scale in, and make money. Bar four trades up to around the two high. So the bulls who bought the close of bar two, they're disappointed in three. They probably used it to scale into their longs, and they're using the rally up on bar four to exit at least some of their longs. And that's why there's a big tail on bar four. Bar four, a double top with three. You could argue four is a second reversal down since we reversed down on three and now we're reversing down on four. However, it's not really a very good reversal down considering the fact that that it's a bull bar and that it's a 4-bar micro channel for the bulls. So we have not traded below any prior bar yet today, making me think the first reversal down is more likely to fail than not. Bar five, kind of disappointing, but follow through for the bears, you can see. So if you sold below four, five is not your ideal entry bar. You wanted to see a much bigger bear entry bar closing near its low. But instead, you got a bear entry bar that has a big tail on the top. So really not as good as it could be. There's probably sellers not too far above bar five. Bulls see, you could argue it's a high one because bar three, we never traded above bar three or bar four. So you could argue bar five is a high one. You could also say, I think that bar four reversed up and then reversed back down, and now reversing back up on bar five. So you could also look at bar five as a second reversal up. However, what's important to notice is that first or second reversal up, it's a bear bar, so it's not really all that good. So the same way it wasn't a very good sell below bar four, it's not a very good buy above bar five. Granted, we are always in long, but I think it's better to be waiting and seeing what happens. The bulls want a strong bull bar closing near its high on bar six, so they want a good entry bar for bar five, and then probably consecutive bull bars closing near their highs to make the market buy the close and convince traders that bar one is the low of the day. Right now, after, the context might have been good enough to call bar one a potential low of the day, but I'm not really all that sure. Well, obviously, any given bar one has a 20% chance of being the low or the high of the day. So when you see bar one and we trade above bar one, there's a 20% chance that we've seen the low of the day. Again, with the big gap down and the bull bar closing near its high, it might be 30%, but I'm not really sure. It might be more like 25%. I think if we got an even bigger gap down and got down here and got a reversal up, maybe like a lower low double bottom or an exact double bottom with this low on bar one. So let's say bar one opened like here and we got the same reversal up. I think that might have more of a 30% chance of being higher at the low. Why? Because as strong as this is, it's in the middle of a trading range, and we might have to test back down to this really big bull bar because it's an important support point. And this bear close is going to be important support as well. As you can see, it was on bar 9. Any bears who were short, you can see a lot of the bears who sold this close were really disappointed with how big this rally was. And they scaled into their shorts all the way up, and they used the sell-off on 9 to get out around break even on their first entry with a profit on their scale-ins. So it's really not as ideal as it could be. My point being 1 as a possible low of the day. It's not as ideal as it could be. So anyways, 6, a bull bar, but not quite closing on or near its high. I think we're getting pretty neutral here. If we were strongly bullish, we'd be going up in a more convincing fashion. And if we were strongly bearish, we would not be always in long, and we'd be getting a better looking reversal down. Bears know we might get one more quick push up, but they're hoping that it will be short-lived and we'll get a strong reversal down, maybe a wedge top of some kind or some sort of double top. And instead, we get a surprise bar on 7. There's often a surprise on bar 7, maybe due to some sort of news or just due to the nature of the market. Well, obviously there's news at 10 every day, but it doesn't always affect the market. So in general, it's better. It's tough to take a trade on bar 6 because bar 7 can be so volatile. And if you were watching closely towards the end of bar 6, the market started trading a little bit erratically, and then that is part of probably what led to the big move immediately on bar 7. And if you were watching, you saw that bar 7, micro gap down, and then basically became about half the size that the bar ended up being within the first 2 or 3 seconds of the bar. So 7, a huge bear bar closing near its low, probably makes the market always in short. You know that once we get the gap down, we're probably going to get some sort of second leg sideways to down. And you can see from the gap, and you can see bar 7 was the second leg down for the bears. So really strong bear bar closing near its low. Are you selling below 7? I personally would not. You probably can, but the thing is, that yesterday's bar 36 close right here. So you know that this close is going to be a magnet, as you can see that it was. So if you're selling down here, your risk reward really isn't all that good selling the close of 7, trying to get to right here. And that bar 6 was your sell signal bar. So there's probably traders who bought the low of 6 who are scaling in lower. And with how strong bars 1 and 2 were, this is probably a trading range open. As strong as bar 7 is, it needs follow through to convince traders that this is going to be a bear trend from the open. Because bars 1 and 2 were so strong, it makes me think this is less likely to be a big bear trend. And so what happens? You can see on bar 8, we pull back 50%. Why? Because traders, if they're selling, they want to sell a pullback rather than selling the low. If you're selling the low, trying to get to the obvious magnet right here, we'll just do it this way. You're selling the low, you're trying to get to the obvious magnet right here, right? So you're selling here roughly, and you're trying to make about 4 or 5 points, and your risk is about 10 or 11 points. So that's one risk or two risk for one reward. So you're risking essentially 2 points to make 1 or 10 points to make like 5.5. Really not that good of an equation. But if you wait for the 50% pullback, which happened about 2 minutes into the bar, if you're selling a 50% pullback intra-bar, you want it to be earlier in the bar. If you're 4 minutes and 45 seconds into the bar and it's just finally touching the 50% pullback, you don't want to sell that. You want to sell it a minute or 2 into the bar to give the market time to start to sell off. But anyways, the traders who sold the 50% correction, well, their equation is now they're risking about 5.5 points, trying to make about 10 points. So they basically flip-flopped the equation by choosing to sell the 50% pullback instead of below bar 7. And you might be thinking, well, what if it didn't go to the 50% pullback? If it just went and we got another big consecutive bear bar on 7? Well, then you can sell the close of or sorry, say bar 8 looks like bar 7, well, then you have a giant surprise in consecutive bear bars closing near their lows. We're always in short and we're probably going lower. And so if it's closing below yesterday's low, it becomes even better for the bears. Another reason why there might have been buyers in this area is the daily chart. You can see the traders who sold below 612 are not going to be all that thrilled with how 613 looked. So they might be looking to buy back shorts during today's day session, and that could be contributing to this bounce. That was a pretty long-winded explanation of bar 7, but anyways, bar 8, a follow-through bar for the bears, but again, it shows that with the big tail on the bottom and the big tail on the top, traders were more interested in selling a pullback of bar 7 than they were selling directly below. So to me, I think this is more of a trading range open. Follow through for the bears on bar 9, getting towards the low of the prior day, so getting towards Thursday low. But there's probably buyers somewhere around here, again, because of the daily chart and because of the bar 36 low. And as you can see, there was some profit taking on bar 9. So traders, they see bar 9, a lot of them, let's say you sold 7, you sit through 8, or you sold a 50% pullback of 7, you sit through 8, and you see 9. The goal of traders, once bar 9 basically touched the bar 36 close from yesterday, was they were hoping we were going to close below yesterday's low. The bears wanted to close below the prior day's low and a surprise to the downside. And if they don't get the surprise to the downside, a lot of times what they'll do is they'll just get disappointed and they'll flatten out the market. So they'll just exit their trades. And that causes the big bounce on bar 10, bull bar closing near its high. Traders know they're giving up and assuming it's going to be a trading range open. And so we're probably at least getting back to the bar 6 low. Another follow through bar for the bulls. So, bar 9 would be the lower low double bottom, basically a big high 2 on the open, high 1, pullback, high 2 on the open for bar 9. But it's not really all that ideal because it's a bear bar closing below its midpoint after basically a big sell climax. 11, follow through for the bulls. It's consecutive bull bars, but now we're towards the top of the trading range. And we just had, 7, 8, 9 pretty strong. And 10, 11 is not quite strong enough to totally undo 7, 8, 9. So I'm not really all that sure it's great to be buying in this area. You might be better off looking to buy a pullback from lower rather than buying here. 12, an inside bar, a low 1 short for the bears, but 10 and 11 were pretty strong. So I'm not all that convinced that I want to buy above, I want to short below 12 because, traders who are selling it, I get it. You can say it's 7, 8, 9, strong bear move. We should get a second leg sideways to down. But if you're selling below 12, you're selling in the middle of the range after consecutive bull bars closing near their highs. So it's really not as good as it could be. 13, follow through for the bears. But, again, the downside is pretty limited with 10 and 11. This is strong enough that there's going to be bulls stepping in, strong bulls stepping in down here if we get back to this low. And this is the problem with trading ranges. You cannot buy the close of 11 and put a stop below here because there's going to be more buyers below here than there are going to be sellers. So you can't buy the close up here, put a stop below here, and hope for the best. It's just not something you can do. 14, follow through for the bears. It's 3 consecutive bear bars, but why are the bears allowing so many strong bull closes? It's the same concept as over here where we're getting all these strong bull closes. Why are 1 and 2 really strong bull bars? Why are 10 and 11 really big and strong bull bars? As good as this is for the bears, you can see we got 1, 2, 3 bear bars and then a strong reversal up. Now we have 1, 2, 3 bear bars at the new low where strong bulls are about to step in, and we get the strong reversal up on 15. 15 is a wedge, 1, 9, 15 with the overshoot on 9. It's a reversal up from the prior day's low. I really wanted 15 to stay as an inside bar, but instead I got disappointed and 15 traded above 14, making 14 your signal bar and creating a larger bar with larger risk. It's definitely an okay buy on 15 for a potential low of the day. It's more of a swing trade, but it's definitely reasonable to take the buy above 15, hoping that we've seen the low of the day. However, there's a little bit of a tail on the top, and I thought it was disappointing that 15 traded above 14, as that is a sign of trading range behavior. But we should at least get back to the bar 11 close. I would say at least a 60% chance that we're getting back to the bar 11 close a little bit later today. If not even higher, more like 70% chance we're getting back to the bar 11 close later today. Bar 16, it's follow through for the bulls, but a big tail on the top and a big tail on the bottom. After 3 straight bear bars, 12, 13, 14, it's very possible we have to go a bit more sideways before we can go up. But I think, the bars on the chart are somewhat always in short because we have the spike down or the gap down and then a move down. But I think the context on the close of bar 16 is probably always long because traders down here at the bottom of this trading range would rather be long. Another way to look at it is the spike down. This big gap is just a spike, and then it's a wedge channel. So you could just say wedge on the open, that's fine, but you could say spike, wedge channel, 1, 2, 3, and then reversal up. Either one of those is fine. Again, generally going to lead to a trading range, and big down, big up, big down. Maybe we get big up, but probably going to lead to confusion, and I would imagine we're going to see trading range price action relatively soon here. 17, follow through for the bulls. A good bull bar closing near its high. It actually closes above the close of bar 11, which is good for the bulls. It shows that the bulls who bought the close of 12 were not all that disappointed in how 13, 14, bought the close of 11, were not all that disappointed in 12, 13, and 14. And over here, they instead, they did not use this to sell out of their longs. They instead held. 17 does close above the moving average, which is really strong for the bulls. You can see we have a couple of sell climax highs here. So this is a possible target. This is a possible target. And we're probably going to break out of the 18 bar range. And following the 3 straight bull bars, 15, 16, and 17, the most likely scenario is that we break out to the upside of the 18 bar range. An inside bar, a doji bar on 18. So for the bears, for the bulls, they see a high 1 pullback, but the bears know that after big up, big down, big confusion is likely. And so what's probably going to happen, again, when you're going to buy the close rally and you see a doji bar, the buy the close is probably coming to an end. So if you're a bull and you see 18, your mind should automatically, stop thinking we're in the spike phase, and you should start thinking, okay, we're probably transitioning into a channel now instead of the spike. I don't know if this is going to work. I'm going to see. So my premise here, I haven't tested it, but it looks relatively similar. A lot of times when you get a spike, a pullback, and then a channel, the channel becomes the leg 2 of the spike. So 15, 16, 17 looks like a leg 1. And then the leg 2 would be from the low of 20 to the high of 25. No, okay, that wasn't it. I was just curious, though. That does happen relatively often, where you get a spike, a pullback, and then the channel is the same size as the spike in a leg 2 fashion, rather than the 60% chance the measure move up. But again, buying the close of 17, theoretically still a 60% chance of a measure move up, and you would have gotten it at the end of the day. Even the wider one you probably would have gotten. Unlike the very last bar of the day, obviously the vacuum test of yesterday's close. 19, an outside bar, but disappointing for the bulls that it was not able to close on its high. It's looking like potentially some sort of second leg trap. And again, this is consecutive doji bars. So I think the buy the close is relatively done here, and we're probably going to go sideways. It's a trading range though, so the pullback could be deeper than you want it to be. We're going to get a second leg up from 15, 16, and 17, but you can get a disappointing pullback. You can see on 10 and 11, we got a pullback below the low of the spike before we ended up getting the second leg up. That happens about 30% of the time. Bar 20, a bear bar with a reasonably strong close, but the bears, not really all that much to sell. 15, 16, 17 is really strong, and we might have to get back to the 14 close at some point today. Remember, whenever the market creates a reasonable sell to close bar, it would have been better for the bears had we triggered below 14 and gotten the reversal up. It would have made it more likely we had to get back to the 14 low, because then even more bears would have been trapped than there already were. But still, whenever you get a big magnet like 12, 13, 14, you know that there's a 60% chance we're going to get back to that close, and an 80% chance if you sell below a bear bar closing near its low, you're going to be able to get to the midpoint of those two sells. So you can see if you sold the close of 14 and you sold more below 26, that was your opportunity. You sold more here. It was also a spike in a wedge channel. You can see spike here, and then wedge 19, 22, and 25. So wedge channel. So it was reasonable to sell below 26 for basically a scalp to the midpoint of those two things. Anyways, 20, a big bear bar, but to me, it's just bulls taking profits. There's not really anything to sell here. At best, 20 should get a second leg sideways down, but it's the middle of a trading range. I'm not all that eager. 21, a big bull bar, but a tail on the top, so not as good as it could be. We probably should go at least a little bit higher, but I'm not sure how much higher. This does not look overly bullish to me. 15, 16, 17 looked really bullish, but now we have a lot of disappointment for those traders. So again, the best case scenario for the bulls right now seems like a channel up realistically. 22, another doji bar. So a lot of problems. 18, 19, and 22 are doji bars. Why are we getting so many doji bars if this is a good buy the close bull trend for the bulls? When you're getting these pullbacks and these tails like 18, these big tails 19, these big tails 22, shows that bulls are buying pullbacks, but then you have lackluster follow through on the upside. So it shows that bulls are instead using the rallies that are strongly to the upside, like the tail on the top of 22. The traders are using that to take profits, and they're using the sell-offs as pullbacks into the buy zone. So they're instead buying low and selling high. So again, when traders are buying low and selling high, but you're moving up, it's a bull channel. It's not really a bull trend. And this whole day was a bull channel. So there's good examples of that here. 23, more follow through for the bulls. But again, this is really far from ideal. You can see we broke out to the upside of the 18 bar range, but we failed a big tail on the top and the bottom of 23. An inside bar 24, it's a high 1 buy for the bulls. We had a high 122, not really that much follow through. A high 124, not really that much follow through. Again, 1, 2, we might form some sort of wedge. What do bulls want? Bulls want to break out to the upside of the 18 bar range. They want a strong close somewhere up here, and they want to get some sort of measured move up of the spike, probably from 15, 16, 17. They probably want to get to around yesterday's close, which is around where that was. So bulls are hoping we get a break up to the upside and a measured move up. What do bears want? Bears know that this is probably a trading range and that we might have to dip down a little bit before we can rally. So they're betting that any rally to the upside is not going to be all that strong. And so basically 25 is but more or less a decision bar. 25 closes on its high. There's a increased chance that the bulls can get more follow through on 26, and this turns into some sort of bull trend. But instead, you get a disappointing close on 25, and traders sell out of their longs, and that causes bar 26, a bear bar closing near its low. Again, reasonable enough to sell 26 and think we're going to get to the midpoint. I think that's a pretty strong sell. So 26, a wedge top. You can see we had a spike in channel. Probably going to be a trading range here. I can't imagine we're going that much higher. And you can see bulls exit, and that causes 27, a bear bar closing near its low. Good for the bears, consecutive bear bars. Can you sell 27? You probably can, because it's consecutive bear bars closing near their lows. So probably going at least a little bit lower. But now you're selling in the middle of the trading range. So, 26 is where the sell is. 27 is not as good of a sell. You're also testing the bar 21 buy climax high. If you think about it, 15, 16, 17 is the spike, and the channel started at the 20 low. So if you're selling 27, you're selling on support because the lows of channels are going to be support. So it's really not as good as it could be. You do get some follow through 28, good for the bears. We might test back down to the 14 close, but again, even if we do, there's probably buyers down there. So if you're selling down here, your risk is really large and your downside is limited, and that's not really the kind of trade you want to take. It's not a great trader's equation. 29, an outside or almost outside up bar, but you could call it outside up. It's a good bull bar closing near its high. I think it's reasonable for bears to exit and bulls can buy, but you know that 26, 27, 28, pretty strong. Bulls want to see a higher low double bottom essentially with 15 and, maybe a breakout pullback, breakout of the high. So bulls could argue that this was the breakout and we broke out of the high. We got a really deep pullback and now we're going to get the bull trend, which more or less is what happened, but I think it's reasonable to buy above 29, but you probably want relatively quick follow through. This is not a trade you want to sit in for all that long. And if you notice, let me check something. 15. Was that the missed 5-point scalp? There's a couple of 20 tick trap. No, that wasn't it. 20 tick trap. So anyways, there's a 21 tick trap where if you bought above bar 29, the market has to go 22 ticks in order to let you out, and it only went 21 ticks on bar 30. So it needed to go 5.5 points above bar 29 for traders to make 5 points, and it only went 5.25 points above bar 9 for trades. So traders are 29. So traders were not quite able to make a 5-point scalp buying above bar 29 on bar 30. And a lot of traders, they saw the close of bar 30 and they decided, yeah, consecutive bull bar is good for the bulls, but following 3 straight bear bars, we might have to test back up into this area, but I got almost a 5-point scalp and I have no true risk. I'm just going to exit the trade. And that's what causes bar 31 to dip down. Bulls, so limit order bulls will see this, and they'll see this as an opportunity to buy a pullback early in the bar. They're hoping that we get a bull bar closing near its high, but they know it's probably not going to happen. You instead get a disappointing bar 31, an inside bar, a high 1 for the bulls, but not really a very good high 1 considering that it's a bear bar. Follow through for the bulls on 32, but a tail on the top. So, we're on the quote unquote buy above 31, but it's a bear bar. Bears thinking that this is probably going to be some sort of second leg trap to the upside. And then 33 breaks out to the upside. I think if you're long, you just scalp at the new high. And if 33 closes on its high, you just buy it back. So I thought that would make a lot of sense to do. You're long for any reason, you've probably made some money. and just exit at the high. And then if 33 closes and breaks out above the 25 high, great, you can just get back into the trade. I think that makes a lot of sense to do. And you can see any of the traders so some traders did that and they sold out of their longs 33. They saw it didn't close on its high, so they were not willing to add. Other traders saw that 33 was unable to close on its high, and they had held through the trade, and they're now disappointed. So they exit at the market, and that causes bar 34, a bear bar. An inside bar, a high one for the bulls, 35. But I think, after this second leg trap, we're probably going to get at least 2 legs sideways down. I do view 30, 32, 33 as a second leg trap within a trading range. You could argue this whole channel was a second leg trap. So second leg trap within a trading range, so probably at least 2 legs sideways to down, and 34 on its own is probably big enough to bring a second leg sideways to down. An inside bar, 35, a high one, but probably buyers below, probably sellers above. I'd rather wait and see what happens. The bear bar closing near its low 36, but again, just looks like a second leg down. And how low are we really going? The bear attempts have not been all that successful today. They've gotten a couple of consecutive bear bars, but the bulls have overall had, I think, the stronger moves so far today. And I think in general, we're in an area where bears might be buying back shorts on the daily chart. So because of that that low I had mentioned. So we are forming some sort of triangle here, right? So it's hard to be taking shorts. Reversal up 37. It's a small bar. That's the big thing this has going for it. It's a reasonably tight channel down, so I'm not sure how much higher we're going to go, but it's reasonable to buy above 37. The problem is it's right on the moving average. But traders like small bars within trading ranges, and it's on the channel line. So it's reasonable to buy above 37. First reversal up, pullback, second reversal up. I would argue 37 is a high 2, closing right at the moving average. And you could buy hoping we get a test of the 33 close, which is exactly what we got on 38. 38 consecutive big bull bars, but the problem with 38 is that we're right at the high overall, right? So we're right at resistance, the top of the trading range. So it's really not as good as it could be. This day ended up being relatively small. I thought we might get some sort of breakout today, but there was just so much trading range price action that it's probably better to just wait until it happens. So 38, a good bull bar closing near its high, but the bulls need one more bar on 39, and they don't really get it. I know it's a bull close on 39, but it's a doji bar. It's really not what you want to see. You were hoping to see another bar that looked like 38, or at the very least, a bar that looked, like 37 or something, You wanted to basically see a bull bar closing near its high, breaking above the high of the day. Instead, you get a doji bar 39. So deep pullback on 39, and then a second leg up. So you could argue that 37, 38 consecutive bull bars, and then a pullback during 39. And so the tail on 39 represents the second leg up for the bulls. And that's why you get traders selling out of their longs on the close. Disappointed 39 wasn't able to close stronger. And you get a disappointing bar on 40. So sometimes you get a big reversal down on bar 40 because 39 ends up being the second leg up and a second leg trap, some sort of nested second leg trap. So it's not really all that great. 41, outside down, bear bar, but not quite able to close on or near its low. Again, I think more sideways here. Sorry, that was a weird voice crack. A little bit more sideways here in general. 42, a bull bar closing near its high. So we have an IOI pattern. It's reasonable to buy above 42, like I mentioned. You're hoping that we get a breakout to the upside. Maybe it's a wedge, 25, 33, and 41. But look at all the big bull bars we've had so far today. 17, you could argue that, so 15 had reasonable follow through, but 17, 21, 28 had okay follow through, but 30, not really great follow through, 38, not great follow through. 42, it's not really a spectacular bull bar. You're hoping you're going to get good follow through, but the upside might be limited. 43, disappointing follow through. Some traders might sell because it's a wedge, but you can see traders instead, bulls bought the close of 43 and did not let it trigger, and we got a big rally up on 44. Good for the bulls. 44, breaking out to the high of the wedge. Bulls are hoping that we end up getting a much larger rally here, and we rally to at least yesterday's close, potentially even above yesterday's high to trigger the high one on the daily chart, the inside bar. But instead, you get disappointing, you get follow through 45, but it's not really the follow through you want. It's enough for traders. Again, consecutive bull bars, we're probably always in long, but it's really hard to be buying up here. You're not sure how much higher we can go. And you can see the bulls who bought above 42, look what they did. They need 5.5 points to make 5 points. So 28.75, 34.25. The market needs to reach here in order for those traders to exit their longs. And you can see on 46, it reached there. So now we have a wedge, 1, 2, 3. And what happens? Well, some traders, if you're watching, the tail on 47 occurred before we traded below 46. So some traders bought the close of 47, hoping that we were going to get a big rally and we were going to get, maybe to yesterday's close or maybe somewhere up here, maybe break above the high. But instead, what ended up happening is once we rallied back to that spot where they knew they could make 5 points, they said, yeah, 5 points is good enough for me on this trade. I didn't like how big 46 was. I'm just going to get out. It's a trading range day. And that's why we got the big reversal down 47. And inside bar 48, I think that 46 is some sort of wedge. So 46, 47 consecutive bear bars. We're probably going to get a second leg sideways down, which makes the buy above 49 tough. So inside pattern, 48, 49, potential final flag. Even if we break out above it, we're probably going to end up getting a sell-off back to it. And you can see you get disappointing follow through on 50. So if you bought above 49, you get disappointed 50. Traders exit below, that causes 51. Traders are expecting a few legs sideways to down, not really willing to buy. An inside bar, 52, closing near its low. Good for the bears, but overlap with the 50 low and a lot of overlap, obviously, with 51, so not all that great. The channel up was relatively tight, so I'm not sure how much further down we could really go here. 53, you can see probably buyers below 52. Probably at least another leg sideways to down, so not really looking to buy anything here. I'd rather look to buy a reversal up from lower. 54, a big bear surprise, but a big tail on the bottom. We might be forming some sort of wedge, 51, 54, and then maybe, 56, 57, something like that. 55, a breakout below 54, but really not all that good. 55 is more of a reversal up for the bulls. It's, you could argue that, again, 53 is high 1 and 55 is the high 2. But it's a bear micro channel, so it's really not all that great. It's reasonable to argue it's a high 1 as well. It's also a bear bar, so there's probably sellers not too far above, but this isn't all that ideal for the bears. So the traders who are selling above 55 are doing so for a scalp. They're looking to sell above and sell in a point or two higher and get out probably around the midpoint of bar 55, I would imagine. 56, a huge bear bar, but a big tail on the top and the bottom. No one's really willing to sell below that. I think I would rather wait. And then inside bar 57, but to me that looks like a final flag. Big reversal up 58, so 51, 54, 58. 3 pushes down and a wedge, but I think it's a little bit too big. I'm not quite willing to buy above 58. I'd rather wait. And then you can see we got follow through for the bulls, 59, but getting relatively high in the range, I think they need at least one more good bull bar, and instead you get a disappointing bar 60. Bears who are selling 60 are hoping 58 and 59 is a bull trap. 58 was pretty big, and it had a tail on the top around the moving average. So if you're buying above 58, you were probably willing to scale in. And a lot of those traders, probably just tried to make 3 or 4 points and maybe just took it. I don't think they were quite able to make 4 points. Yeah, so 4.25. So it needed to go 4.5 points, but only went 4. So those traders, 17 tick trap instead of getting the full 18 ticks. If you don't understand that concept, by the way, it's in Al's course. Just go look at the course or go look in the book about reading about 21 tick traps and 41 tick traps and stuff. It'll take you maybe an hour to start to understand it. But anyways, 60, a bear bar closing near its low. If you sell below 60, I probably wouldn't. You're right on the moving average after consecutive bull bars. We'll probably have to test back into this area, but this is just starting to look really tight to me, so nothing looks all that great. Bad follow through, 61, a tail on the bottom. More follow through the bear 62, so might be good enough to get a second leg sideways down after 3 bear bars, but we're probably going to test back to the 59 close at some point. And then a big reversal up on 63. It's a higher low double bottom. You could argue a breakout pullback, but I just see a double bottom. 50, 58, 63, 40% chance you get a breakout above the neckline and a measure move up. But I don't know. I don't really, it never looks like it, but 40% chance that, we just get a rally up to here. But there's not enough time left in the day for that. So I don't really want to take that kind of trade. I'd just rather wait. You get more follow through for the bulls, 64, but basically tail on top, tail on the bottom. Then a huge bull bar, 65, but it's a wedge, right? So 56, 60, and 65. So it's a wedge top. And you don't really want to be buying a big bull bar right near the top. Additionally, if you're buying this close, you're buying right where the traders, if you bought above 49 and held, you're pretty upset. So if we go 1 tick above 65, we're going basically right to where the bar 49 close was as well. So it's a wedge, and it's an area where there's going to be sellers. And you can see the high of this was 54, 28, 25. So we needed to go to 33.75, and we went to 33.50. So if we trade 1 tick above 65, we're triggering we're right back to here. So these traders who probably going to want to sell out of their longs. You know, it's a big bull bar at the top of the trading range. So big bar, big risk, not as good as it could be. It's a wedge, probably a couple legs sideways down, and basically where traders are going to be able to scalp up 5 points. So it's not really worth buying 65. Instead, you can see traders bought below 65. Whenever you get the bars where you're not sure if you should buy above it, a lot of times in trading range, it's better to buy below them. And you get disappointing close for the bears, 66, triggering essentially a low too short, but it's not that good. It's the wedge, right? So you're triggering the wedge below 65, but it's a big bull bar closing near its highs. So there's probably buyers below. 67, a bull bar, but just testing back to the 65 close. I'm not buying that unless 67 is able to close decently above 66 and convince me that traders were not disappointed with how 66 happened with 66. So buy the close bull 65. You'd have to convince me that traders are not disappointed with 66 and they're not going to exit 67. You can see instead they did, and it caused a 68. Then you get a disappointing bear close. A lot of traders exit the market 69, and we went sideways and got a bounce to yesterday's close. Stop orders on the day. Probably the first reasonable one. First decent one was 15. 26 made sense. Probably 29. You could do 37, 38, but I don't think any of that's all that great. 42 again, but probably not all that great. 45 again, but really not ideal. You got to be pretty quick to get out. Then maybe 63. It wasn't really a great day for stop order traders. But you can see limit order traders making money. They're buying, fading breakouts below 1, fading breakouts below 9, scaling in, making money. So much better day for limit order traders in general than stop order traders. On the daily chart, so you can see we have this breakout and a high 1 buy here, but I don't, high ones usually lead to pullbacks and then second legs up. So I would not be surprised if we traded above here and then we got a pullback and then attempted a second leg up in trend resumption after. But I do think we're probably going to end up closing this gap. I'd be surprised if it stayed open for another couple of weeks. It'll probably close relatively soon here. And then on the weekly chart, you can see the weekly chart just closed. So a good bar for the bulls, consecutive bull bars closing at their highs. But again, I think we're pretty high up in a pretty climactic move. And this is just such a big problem for me. The bulls are doing a good job at undoing it, but this is big enough to me that I'm still not quite convinced that this is just a pullback in a bull trend. This many strong bear bars and bars being this climactic and humongous. I think the bulls need really a couple more really strong bull bars to convince me that this was just a minor reversal. It is still a minor reversal, but I think that we're probably just going to start to go sideways relatively soon. This is not bull trend behavior. Yeah,